Welcome to the Gold Newsletter Podcast, your bank of knowledge of investments, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives to increase your wealth monetarily and educationally.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host, with Brian London in New Orleans, Louisiana. And we have on today a man whose name I'm going to struggle to pronounce, but Ronald Stöferle. And he'll give us the precise pronunciation in a second. But he is a partner of Incrementum AG. We've had Demelza Hayes from this organization on with us before. And he has a very long history in finance. He's probably most famous for his annual report in Gold We Trust. He's also written or co-authored Austrian Economics for Investing. What's the title of that other one?
Austrian School for Investors, Austrian Investing Between Inflation and Deflation.
Today we're discussing, how the gold price, as it is rising, will impact mining stocks. But maybe we can have a crack at that book too, because it particularly interests me. So, Brian, did you have any questions you want to get started with?
The gold bug and gold investing world is eagerly awaiting this year's version of In Gold We Trust. And Incrementum just released a kind of a teaser for the first time, a chart book. And I was wondering if Ronnie could kind of summarize that preview, as it were.
Yeah, absolutely. It's a pleasure. Thanks for having me. Not only the gold world, but also my family expects the release of the next gold report because it's always a hell lot of work. There are 15 people involved writing the report, layouting it, proofreading it, translating it. It will be the first report that will actually be translated to Chinese as well. So it's a big project, and we already wrote some fantastic and really thought-provoking chapters. So 28th of May is the big day for the release of the gold report in German, in English, and in Mandarin, in a short version, but also in an extended version, probably more than 200 pages. So quite an extensive read, and you probably have to reserve a weekend just to work through the report. But you're right, as a little teaser and to create some more interest for the next gold report, we just published a chart book, which is, as the name says, our most interesting charts, kind of an update from last year's chart book, but also featuring some new charts. And I think, our main thesis that we presented already last year was totally proven right in the last couple of weeks. We said we've been celebrating 10-year liquidity party, and now with quantitative tightening, with rising rates and so on, not only in the US, but also in the rest of the world, liquidity is sucked out of the market. And our assumption that is kind of based on our thoughts, the Austrian School of Economics, is that this will create a classical boom-bust cycle. So we had a very long boom because of 18 trillion US dollars printed out of thin air by the biggest central banks, artificially low interest rates, quantitative easing, and so on. So this makes the whole system very, very fragile when it comes to rising rates. And I think in the fourth quarter last year, we have perfectly seen that the market needs liquidity, needs low rates, and actually our conclusion was that the Federal Reserve will have to make what we call a monetary U-turn. Now, last week and already before, basically in December, Jay Powell perfectly confirmed our thesis with this monetary U-turn. And I think, with last week's Fed statements, actually they were perhaps even too dovish for the market. They didn't only take out one, but both pledged rate hikes for this year and trimmed its GDP forecasts. And they also are going to change their quantitative tightening program. So there will be some backdoor quantitative easing, and they will soak up almost 25% of treasury issuance. So I think this is really some sort of the perfect storm for gold. So that was something that we described quite extensively in the chart book. In combination with that, I would say we're talking about the US recession quite extensively. Actually, we might already be in a recession. Then we are, of course, talking about what the central banks will do next. I think if recession fears really come up and the market gets more nervous, they will load their bazookas again. There will be further quantitative easing. There will be perhaps even negative rates. Central banks, so the Fed and also the European Central Bank might buy equities or REITs as well. So we should expect much, much more aggressive central bank action, and that should be really positive for gold. And then the next point was the de-dollarization that is really picking up momentum. It's becoming really center stage. Also in politics, it's the axis of gold. Basically, Russia, China, Turkey, India, Kazakhstan buying significant amounts of gold. Last year, we saw the biggest net purchases in the last 50 years. And then, of course, we're also talking about the technical picture of gold as well as mining stocks. So that's a pretty good roundup of what we're seeing at the moment. And the chart book is available for free. You can, of course, download it on our webpage, or you, Brian, can also put it on your webpage for download.
You just hit one of the nails on the head, I think, when you said that's your view of the markets right now. It has to be a challenge to produce this annual report and have events move so quickly. You know, in the past 3 months since the Fed's last meeting, we saw them, at their last meeting, they were still expecting to hike rates 3 or 4 times in 2019. And over that brief period of time, we've seen a complete U-turn, really, like you describe it. They've gone from 3 or 4 rate hikes to 0. Maybe 1 next year, if that. But what they're really not saying is that the next move is very likely to be cutting rates. And that's just an amazing turn of events. Frankly, if I would have predicted that, well, actually, I know you guys did. You predicted that it would be very difficult to have quantitative tapering considering the addiction of the markets to liquidity. And I also predicted early last year that the Fed would halt rates by the end of 2018. They would halt their rate hike program. My view is that the market couldn't take higher rates because of the cost of servicing the debt. And that, of course, was assuming that the Fed was going to be able to continue to hike rates. As it turned out, they weren't able to, and they won't going forward. So you believe that the next step for the Fed will be to actually reduce rates, and do you think that will have any effect, or will they have to go to quantitative easing fairly quickly once they begin to loosen monetary policy?
Yeah, I mean, actually, that's our main assumption, and when it comes to equities, many people thought, okay, that must be super positive for equities, and the initial kind of knee-jerk reaction to the Fed's announcement last week was positive, but then we have seen this massive sell-off on Friday, and I think people should. That's one of the best rules in the market is the best moment to buy the market is on the last rate cut, not the first one, and I think this we have seen that quite clearly last week. And therefore, I really expect that going forward, it will be a tough environment for equity markets. And we have seen when it comes to gold was already building up relative strength to the equity markets. So we often do relative charts, so ratio charts, because they give you more information in an environment that is heavily influenced or manipulated by central bank action. So therefore, we work quite a lot with ratios. And having a look at the S&P to gold ratio clearly shows you that gold is picking up relative strength to equity markets. And, we are talking to institutional players quite a lot. big pension funds, wealth managers, high net worth individuals, and so on. And Q4 last year was really some sort of a warning shot for many investors because basically every asset class was sold off. Gold was really picking up momentum in the fourth quarter. So I expect that an enormous amount of capital is still basically on the sidelines. I know many big investors that really want to get into the gold trade, but everybody is kind of waiting for this 1360 to 1380 resistance zone. And we failed to take that out a couple of times, but I think the next try will be successful. So I think that we're based on a Dow theory, there's 3 stages of every bull market. There is the accumulation phase where only contrarians buy into an asset, where the media sentiment is extremely negative. I think we have seen that 2015 until basically summer 2018. Now I think we're moving into the second stage, which is the public participation phase. That's the longest part of the trend, and basically it shows, mainstream media is picking up on gold again. We're seeing that many analysts are becoming slightly more positive. We can see that some banks are kind of upgrading gold for their clients and so on. And I think, this public participation phase will of course end in a mania phase, like every trend ends, but we're far away from that. So I think the worst is over for gold and especially for mining stocks. And I think as soon as we take out this massive resistance at 1360, 1380, I think we can go to 1450, even 1500 quite quickly.
Every month, for nearly 50 years, Gold Newsletter has unearthed high-potential investment opportunities in metals and mining stocks that mainstream investors didn't even know existed. The value and profit potential we pack into each and every issue of Gold Newsletter make it an absolute steal at just $198 per year. Your subscription includes 2 special reports, Money Multipliers, resource stocks poised to triple, and The Investor's Guide to Gold and Silver. To subscribe, visit www.goldnewsletter.com and click subscribe now to discover how to multiply your returns in today's gold bull market.
I certainly agree with that last statement, but you may have also answered my next question. If someone would have told me in December that by mid to late January the Fed would have given signs that it was going to completely stop its rate hikes and its tapering off of the balance sheet, I would have expected gold to be much higher. And in fact, I'm not really that impressed with gold's performance, especially after that first stab at the 1350 level that failed and it fell back below 1300. Am I expecting too much from gold at this point, or do you see any other external factors that have served to mute gold's response to that dramatic shift in policy?
Well, yeah, I kind of know what you're referring to. I think that I quoted in my last presentations our colleague Adrian Day quite extensively, and he said a couple of months ago, people are expecting too much from gold, and I thought about that quite extensively, and it basically means that equity markets were still doing well. We have seen rising rates, we've seen quantitative tightening, inflation wasn't big problem, full employment, economy doing well, real estate markets doing well, credit doing pretty well. So actually there wasn't too much need for, I would say, mainstream investors to have any allocation in gold. But I think, and that's also one of the main points that we will make in our next gold report, but also the presentations that I'm currently preparing. I think we can basically see in every part of our lives that we're seeing kind of a crumbling trust. Trust is the foundation for everything that we do. But we're seeing, for example, when it comes to media, We're seeing that people don't trust the media anymore. We're seeing it with social media, with Facebook scandal and so on. We're seeing it with Volkswagen and all the car makers with all the scandals. We're seeing it, with doping in sports. We're seeing that stuff like the Flat Earth Society and chemtrails and all that kind of stuff. I know so many people nowadays believing in that kind of stuff. It is a trust game that we are playing, not only in financial markets, and we're seeing it everywhere. We're seeing it also in politics, of course. Yeah, the divergence or the spread between the left and the right wing is getting bigger and bigger all over the globe. We're seeing that, the yellow vests in France, for example. We're seeing, Bill Cosby being a raper. We're seeing in many aspects of our life that trust in the society, in the system is crumbling. And actually, when it comes to gold, when you devalue money, you devalue trust. That's what my colleague Dylan Grice once said. And I totally believe that this loss of trust will be one of the main drivers for gold going forward. And you cannot have just a little bit of trust. I think that this kind of world view that we're having, the believers, let's say the economic mainstream, believing or wanting to believe that zero interest rate policies, QE, only has positive effects and that it just takes a bit longer, the whole recovery. For them, there is no need to hold gold. But then there is the second group. Those are the skeptics. And they already have serious doubts about the sustainability of monetary policy. Mm-hmm. I think it's much more widespread in the financial sector. And those guys are very much pragmatic gold holders. So they are buying into a rising trend. And then, from my point of view, the third group, those are the critics. They've got a strong conviction that the monetary system is flawed. They know about, monetary history. They know that gold is a systemic hedge and an inflation hedge, and they want to have physical gold. So I think it's important to understand those kind of three groups. And if there's really a loss of trust in central bank action and in the financial markets again, I think this will be the main driver for gold.
I've had some interesting discussions, and most recently last week when we were both on an investment cruise, I had some interesting discussions with Peter Schiff about this. And he, of course, believes that the next big financial crisis will spell the doom for the dollar, in particular the doom for the dollar, and he thinks that the other currencies will do much better, at least on a relative basis, and therefore emerging markets and the like. My feeling is that I don't know if the next, and I don't think anyone really can know, frankly, if the next financial crisis and the next boom bust or boom not allowed to have a bust, liquidity surge kind of event will be enough to totally discredit the dollar, or if we'll have to have another 2 or perhaps 3 such cycles before people just say that the dollar and, frankly, other fiat currencies are just ridiculous because they keep getting us into these booms where they have to come back in and create another boom to keep economies going. And that eventually there's going to be just a total discrediting of fiat currencies, and then gold will be the only thing left standing. I think that may take a couple more cycles. Peter thinks it may take the next cycle. What's your view on that, if you have one?
Well, yeah, of course. We could talk about that for ages. We will write an extensive chapter about Exter's pyramid. I don't know if you're familiar with John Exter. He was a very, very influential central banker, and he created this inverted pyramid where in a kind of a deflationary spiral, the money flows out of most illiquid market sectors into the most liquid ones, and basically on top of, or the basis of this inverted pyramid, there's US treasuries as well as the US dollar, while gold is originally outside of this pyramid because it's not a liability of anyone. There's no counterparty risk. But I think, Rick Rule once said the US dollar is a big lie, but it's a very, very liquid lie. So I kind of sense that in the course of a crisis, the safe haven trade might be again into the US dollar, into US treasuries, because it's just the most liquid and most developed financial market. On the other hand, we could also say, we've got a huge rate differential between the Eurozone and the US dollar. We've got much worse economic numbers in the Eurozone than in the US. We've got employment numbers much better in the US. The Fed is doing quantitative tightening while the European Central Bank is still caught in the zero interest rate trap. So you could also say, okay, the dollar behaves like a stock that doesn't move on good news anymore. So perhaps even the worst is already priced into the euro. I don't know, but comparing the euro to the US dollar to the Japanese yen, I don't know if I really want to own any of these currencies, especially compared to gold. And one of our most important long-term drivers for gold is actually the price of gold in several currencies. And it's a great sign that gold is rising in every currency again. And it's not only the US dollar, it's the Australian dollar, it's the Canadian dollar, where gold is actually very close to all-time highs. It is even the Swiss franc that used to be some sort of a Swiss haven. Gold is up 3% this year. So it's a very, very good sign that gold is rising in every major currency again. And that shows the strength of gold at the moment. So in the next crisis, first of all, I think it would be naive to think that the next crisis will be similar to the 2008-2009 crisis. Right. There will be other triggers. There will be other sectors affected. But I think the solutions will be probably the same, but there is declining marginal utility. So we need more QE. We need more aggressive central bank actions to even have some effect. And I've really got no doubt that this will positively affect the price of gold.
And what did you mean when you said that you believe that the United States is already in a recession, or at least could be?
First of all, recessions only get officially announced with a 6 to 9 month time lag, which is kind of weird. But we're seeing several factors indicating that the US is on its way down, and it's not only the US. It's in 95% of all countries worldwide. Economic numbers are coming in weaker than 1 year ago. We're seeing that monetary growth is faltering all over the globe, but in the US, we have recently seen an inversion of the yield curve. We have seen that most numbers, ISM and so on, are significantly becoming weaker. So I think, we might already be in a recession, and the big driver going forward will probably be the corporate sector, where we now have the chunkiest bond market ever. So almost 50% of all bonds are BBB, so one notch downgrade, and they are junk. So if there's a weakening economy, what happens? It's downgrades, obviously, and then there will be massive forced selling by investment managers, ETFs, funds, and so on, that only are allowed to hold investment-grade bonds. So this might be, and I'm very sympathetic to the case that Dave Rosenberg made recently. I think that the trouble really might come out of the corporate sector, the bond market. And with recession probabilities, it's not only our numbers, but it's also the New York Fed probability of US recessions. It's on the highest level since 2009. It's roughly at 30% now. So I think that, as I've said, we might already be in a recession, but don't get me wrong. A recession is not something to fear. A recession is just a reallocation of resources. So a recession creates an enormous amount of possibilities if you're prepared. It's not something that one should be scared of. It just makes the economic system and the capitalist system, if it's still alive, more, let's say, anti-fragile. So it is something basically that has to be, as weird as it may sound, has to be embraced because it makes the system just better for the long term.
You know, Ronnie, one of the things that I've been talking about or really pounding the table about in Gold Newsletter and in my recent presentations has been the real danger of the cost of servicing the U.S. debt. And I see in your chart preview that you're touching on this a bit too. And in my charts and in research from the Fed site, what I've seen is that as the debt exploded as a result of the 2008 credit crisis and the succeeding years of spending, that the U.S. federal debt exploded, but the interest payments really didn't rise that much. The bottom line interest payments didn't rise that much because rates were plummeting at the time. And of course, they made their way to zero. But now what we've seen is, as a result of just those few rate hikes that the Fed was able to get in before the markets kind of erupted in protest, just because of those very small interest rate increases, and because the federal debt had grown so much, that the leverage of those small rate increases has created tremendous increases in actual debt service payments, interest payments by the federal government. This was my main argument as to why the Fed would not be able to raise rates after this year. But it also, as I see you touched on as well, it means that without some major, complete monetary reset, that there will be low rates, ultra low rates, and zero to negative or ultra low real rates for probably for the rest of our lives. That there's no way the government, and in even every developed economy that's also created these huge debts, there's no way that we'll have supposedly normal interest rates again because we simply can't afford it. The debt service costs would swamp the budgets.
Yeah, absolutely. I mean, that's basically a very, very positive long-term case for gold, actually, because as you rightly said, real interest rates are probably the most important driver for gold. And we have seen in the 70s, in the last big bull market, during the 70s, interest rates, real rates were most of the time negative. And then we have seen Paul Volcker coming in, basically killing inflation, raising rates up to more than 20%. And in the 80s and 90s, we have seen mostly positive real rates, it means big opportunity costs for holding gold. And now, since the year 2002, we're seeing again mostly negative real rates. And from my point of view, and I think we share this view, we just cannot afford significantly higher real rates. And the thing is, central bankers desperately want to create higher inflation, higher price inflation. And now the Austrian school comes in because based on the Austrian school, inflation, inflare in Latin means, basically growing the monetary base, and rising prices, that's only a consequence of rising money supply. So we have already seen massive monetary inflation. We have already seen massive asset price inflation. So the next stage, based on Murray Rothbard, would probably be rising price inflation, which is exactly what central bankers always wanted to create, but they didn't really achieve it yet because we have to deal with big time lags. But sooner or later, there will be price inflation. And, we're already seeing big wage inflation in the US, for example. So there are already some signs. But on the other hand, of course, there are also deflationary components. So if we're seeing some sort of a crash in the financial system, the reaction will be falling risk tolerance, shrinking monetary aggregates. Every bank will kind of reconsider loans and new businesses. So that would be deflationary. And this interplay between inflation and deflation is really crucial for investors nowadays. And we've created our proprietary inflation signal that is just gauging what the market is telling us. And based on our inflation signal, since January of this year, we're seeing rising inflation again. And I think, this is already kind of a sign that the massive monetary and fiscal stimulus that the Chinese already implemented last fall, that this will have an effect, that and inflation might have already bottomed and will be rising going forward. So, yeah, as you've rightly said, the debt to GDP ratio, John Hathaway said it's now looks a bit more than like a banana republic. And I think it will be a big problem. Last year, the interest rate service was 440 billion. It will continue to rise significantly. And the big question is, who's going to buy all this US debt? And from my point of view, it will clearly be the Federal Reserve, because if you compare the balance sheet of the Fed compared to the GDP, there is quite a lot of way to go if you compare it especially to Japan. So I think, we'll see a balance sheet expansion big time in the US, and the Fed will have to soak up lots of treasuries.
Just to kind of sum things up, in getting back to this predictive part of what we're all saying, my view has been that we really can't predict the course of the next crisis, and we can't, we don't know whether it's going to be liquidity crisis, it's going to be new triggers, as you say, and it almost has to be somewhat different. And we don't know if the next one is going to result in any kind of a great monetary reset or whether that's many years down the pike. We really can't predict this. But one thing we can know with a fair amount of certainty is that the solution or the main source of protection for investors and perhaps profit will be the same one that's been around for 3,000-4,000 years in all of these kinds of events. And so we don't know whether it's going to be positive, whether this huge liquidity reinjection by the central banks will be positive for equities, or whether equities will suffer this time around. But we're fairly confident that gold will flourish in this kind of an environment and provide protection and perhaps profits for investors who are able to position themselves now.
Absolutely. And I mean that the main reason probably is the stock to flow ratio of gold. So actually, the let's say the gold inflation is significantly lower than the inflation of central bank or fiat money, of course. So it's also something that we're showing in our gold chart book. And I think, this kind of pre-built inflation, so since 1900, we had on average 1.6% growth of the gold production. So if you own an ounce of gold, the amount that you're inflated at is 1.6%. That's the new gold that is mined throughout the years. So the stock to flow ratio comes to 64 years at the moment. And this just shows you, compared to fiat money, this relative scarcity that we're seeing. And it's, from my point of view, it's all about relative supply curves. So the supply curve for bullion is far, far more inelastic than is the case for paper money. It is really that simple from my point of view.
Well, if you want to follow up, go to ingoldwetrust.report, and you said your latest edition will be coming out in May. The other book to look at is Austrian School for Investors. And I know you are active on Twitter. I'll include that in the show notes. Go to goldnewsletter.com/podcast. Otherwise, Ron, thanks so much for your time.
Thank you very much. It's been a great pleasure. And hope to be on the show soon again, perhaps after we release the next gold report.
Love to do that, Ronnie. And I just can't recommend this report and even this preview highly enough. It's remarkable. We could talk for another hour and not even touch on all the topics you present just in the preview. And it's been our pleasure and our honor to be able to talk to you about this, and we look forward to the full report.
Thank you very much. I really appreciate it. Thank you, gentlemen.
Bye-bye.